Current live data shows Plug Power Inc. is trading at exactly $1.91 USD, down a staggering $0.23, representing a decline of 10.71% in today's intraday session alone. This is not a drill, and this is not a standard market fluctuation. What you are witnessing on your screen right now is a capitulation event, a moment where the floor falls out from under a stock that thousands of retail investors have held on to with grit and optimism for years. If you are looking at your portfolio today, the sea of red surrounding this specific ticker is telling you a story that goes far deeper than just a bad earnings miss or a sector rotation. The expectation for Plug Power has always been that it is the undisputed leader of the hydrogen economy, a company that would eventually grow into its massive valuation once the world caught up to its vision. The reality, however, which is hitting the tape right now with brutal force, is that the company is facing a liquidity crisis that is forcing it to dilute shareholders at the worst possible time, while simultaneously walking away from the government lifeline that everyone assumed was a done deal. When we look at a move of 10.71% to the downside in a single session, taking the stock below the psychological $2 barrier, we have to stop looking at the charts like optimists and start looking at them like realists. The catalyst driving this massive sell-off is the announcement of a $375 million convertible senior notes offering. Now, to the uninitiated, raising capital sounds like a responsible move for a growth company. But here is the cold, hard truth that the market is pricing in right now. Convertible notes are a double-edged sword that often slices the equity holders. By issuing this debt, Plug Power is essentially admitting that it needs cash immediately to keep the lights on and the electrolyzers running. And the terms of these notes mean that if the stock price doesn't recover, the debt holders convert into shares, flooding the market with new supply and diluting your stake. This is why you see such aggressive selling. Institutional arbitrage funds are likely shorting the stock against the notes they are buying, locking in a spread and driving the spot price into the ground. This price action creates a massive divergence between what the average retail investor on the Robinhood app expects and what is actually happening. The typical user engaged in Robinhood stock trading sees a low price and thinks, discount, expecting a quick bounce back to $3 or $4. They might even be using Robinhood fractional shares to load up, thinking they are buying the bottom. But the reality is that the smart money, the funds utilizing interactive brokers' trading terminals and paying close attention to interactive brokers' fees for short borrowing, are betting that this is not a dip, but a repricing of bankruptcy risk. They see the suspension of the Department of Energy loan guarantee activities not as a pause, but as a signal that the political winds have shifted, and the free government money that was supposed to prop up this sector is evaporating. Let's talk about that expectation versus reality gap again, because it is the most critical thing to understand about Plug Power right now. The narrative, the expectation, was that the $1.66 billion loan from the DOE was secured. It was the safety net. Investors using Schwab Intelligent Portfolios or getting investment help from financial advisors were told that this government backing validated the technology and the business model. The reality we are facing today is that Plug Power has paused its pursuit of this loan because the conditions are too hard to meet, or the political environment following the recent election signals that the loan might never actually fund. This removes the safety net. Without that government backstop, Plug Power is forced to go to the open market to raise cash, which is exactly why we are seeing this convertible note offering today. The market hates uncertainty, and right now Plug stock is pure uncertainty wrapped in high cash burn. It is fascinating to watch the volume profile on a day like this. You see millions of shares changing hands, which indicates a battle between the trapped longs who are selling out of desperation and the high-frequency traders who are scalping the volatility. If you are managing your own money, perhaps through self-investing on a platform like SoFi Invest, you have to be extremely careful not to get caught in the wash. SoFi investing tools and SoFi stocks dashboards are great for seeing the trends, but they don't always convey the sheer panic happening on the institutional side. When a stock breaks a level like $2, algorithmic selling kicks in. These are automated programs that simply dump stock when a number is hit, regardless of the fundamentals. We are seeing that cascade right now. The price of $1.91 is not just a number. It is a graveyard of stop-loss orders that were triggered on the way down. Now compare this situation to the broader market sentiment. You have Tesla stock and Nvidia stock making headlines for dominance and cash flow generation. Those companies have matched their hype with execution. Investors in Apple stock sleep well at night because the company sits on a mountain of cash. Plug Power is the inverse. It sits on a mountain of promise but burns cash at a rate that terrifies credit analysts. This is why online investment communities are so divided. You have the die-hard believers who think hydrogen is the only path forward for green energy, and they are willing to suffer through these drawdowns. Then you have the pragmatists who look at the balance sheet and see a company that spends dollars to make dimes. If you are using Fidelity investments for your retirement, perhaps holding Fidelity mutual funds or Fidelity ETFs, you likely have very little exposure to this name directly, as risk managers for those funds have likely trimmed this position months ago. Fidelity Wealth Management advisors typically steer clients away from companies with negative gross margins unless it is a very small speculative part of the portfolio. However, for the active trader using the Fidelity trading platform or the Fidelity mobile app, this volatility is an opportunity. The swings are wide enough to make money on the short side or the long side if you can time the bounces. But let's be clear, this is not investing right now. This is gambling on survival. Let's pivot to the business itself to understand why the cash burn is so high. Plug Power wants to build an end-to-end green hydrogen ecosystem. They don't just want to make the fuel cells for forklifts, which is their core legacy business, that actually works okay. They want to build the electrolyzers that make the hydrogen, the liquefaction plants that transport it, and the infrastructure that dispenses it. The ambition is massive. It is akin to Tesla stock in the early days, trying to build the car, the battery, and the charging network all at once. But the difference is that electricity grids already existed. Hydrogen infrastructure does not. Plug has to build the market while simultaneously selling into it. This capital intensity is what is killing the stock price today. Every time they build a plant in Georgia or Texas, it costs hundreds of millions of dollars. If the plant faces delays or if electricity prices spike, the economics fall apart. The recent news that they are suspending the DOE loan process to evaluate the new political landscape is code for, "We don't think we are going to get the money under the current terms." This is a massive blow to the bull case. The expectation was a government-funded bridge to profitability. The reality is a rickety bridge built on high-interest convertible debt. This is why we see the stock down 10.71%. The market is pricing in the cost of capital. If Plug has to borrow money at 6% or 7%, or effectively higher via convertible dilution, their path to profitability gets pushed back by years. Comment below how many shares of Plug Power you currently hold and what your average buy-in price is. I want to see where the pain points are in this community, or if you managed to get out before this drop. Furthermore, we have to discuss the competitive landscape. While Plug is struggling, other players are moving cautiously. The hydrogen sector has cooled significantly. Investors who were looking for investment help in the green energy sector 2 years ago were told to buy everything. Now, intelligent portfolio algorithms are rotating out of speculative growth and into value. This macro rotation hurts Plug disproportionately. When interest rates are high, future cash flows are discounted heavily. Plug Power's profits are all in the hypothetical future. Therefore, in a high-rate environment, the stock is worth significantly less today. This is basic finance, but it feels personal when you see your Robinhood crypto or Robinhood investments account bleeding red. It is also worth noting the role of short sellers here. The short interest and plug power has historically been very high. When a stock drops 10% in a day, sometimes you get a short squeeze where short sellers take profits and buy back the stock, causing a bounce. But today, the selling is so relentless that it suggests the shorts are pressing their advantage. They smell blood. They know the company needs cash. They know the convertible note offering signals weakness. They are not covering, they are doubling down. If you are using interactive broker stock trading tools, you can see the borrow fees fluctuating. When it becomes expensive to short a stock, it usually means the trade is crowded. But in this case, the crowd seems to be right. The narrative of green hydrogen is the future is hitting the hard wall of